Hello everyone, welcome back. So let's starting with the and next topic, that is the additional depreciation. I hope you have already studied till now. Okay, watched the lectures and also practiced and also keep on revising each and everything, whether it is the basic concept thing, basic concept chapter, the questions of it, and even the PGBP. Try to devote at least an hour after the lecture to revise each and everything of the chapter that we have completed till the date. Okay, now starting with the additional depreciation concept. See, as the name suggests, it is an additional depreciation. Till yesterday, we have completed the depreciation part. Okay, over and above the depreciation, you are going to get an additional depreciation, which is talked about in the next section, that is section number 32, subsection 1, clause 2A. Okay, what is the additional depreciation? It is okay, it says that if you are purchasing a new planter machinery, listen to me very carefully. If you are purchasing a new planter machinery, okay, and you are a manufacturing businesses, okay, or a business of generation, transmission, or distribution of power. If you are a manufacturing business or a business of either power generation or power transmission or power distribution, then you are going to get an additional over and above the normal depreciation that we have studied yesterday. You will get additional 20% of the cost, whatever the cost of the particular asset that you have purchased. Well, it should be a new planter machinery that you must be purchasing, okay, and installed as well. And on that you will get what, 20% of the cost as the additional depreciation. Understood? First thing is clear. Yes. Now if the asset is used for less than 180 days, in the in the normal depreciation we have seen that only 50% is allowed in that case, and the balance 50% will not be carried forward. But yesterday also we have also identified and studied that there is an exception in the additional depreciation, which says that if you are using the particular asset is for less than 180 days in this particular year, so the balance 10% is going to be allowed in the next year, and this additional depreciation is only the one time benefit. For not lifelong of that particular asset you will get the depreciation, no, for only once you are going to get the depreciation. That is the beneficial benefit of additional depreciation. Understood or not? Tell me that first of all. Yes. Now first we'll study that if the assessee is engaged in the manufacturing business of any article or thing, or in the business of either power generation or power transmission or power distribution, and has acquired and installed, important thing, new plant and machinery. The word is here is what, new plant and machinery. Second hand plant and machinery is not allowed. Then the further 20%, further means over and above the normal depreciation, the further 20% of the actual cost shall be allowed as additional depreciation. Understood? If the asset is used for less than 180 days, then the balance 50% can be carried forward to the next year, unlike the normal depreciation. Like in normal depreciation, if the carry forward was not allowed, but in the additional depreciation it is allowed. Now when we are saying that you must be purchasing the new planter machinery, so there are certain conditions to it when the additional depreciation shall not be allowed. In respect of when this additional depreciation benefit will not be allowed to you. See, we want that you purchase the new planter machinery, but you are purchasing the second hand planter machinery, whether it is already used in India or used in outside India. You are saying that, sir, it was not used in India, we used in outside India, and now in India it is like a first hand. No, it is a second hand, it is already used. So point number A is very basic, that we are putting a condition that new plant and machinery should be purchased. Now why you are purchasing the second hand plant and machinery? It should be a new plant and machinery only. Okay, now if we are saying that you should have a manufacturing business, okay, you should have a manufacturing business, power generation, transmission, or distribution business. That means if I am saying that you must purchase a new plant and machinery and acquire installed for the manufacturing business, so I mean to say that it should help in the production business, it should help in a production or generation of something. Na, it should help in your business, it should help the generation of your business, production capacity should increase. But what you have done, you have purchased certain plant and machinery, suppose AC, the air conditioner is also a plant and machinery, installed in your residential area, installed in your office premises. That is not allowed for the additional depreciation. What is allowed? If you are purchasing for the AC, na, put it into the factory, put it into the factory for some workers help, or for some for something which will help you to increase the manufacturing business, okay, which will help you to generate which will help you in generation, transmission, or distribution of the power. It should be in the factory kind of the thing. If you are installing it in the office premises or the residential accommodation, then it is not going to be allowed. Any machinery or plant installed in any office premises or any residential accommodation, we are not going to allow it, because we want that you purchase some plant and machinery which will help you to increase the manufacturing business, which will help you to increase the generation, transmission, or distribution of your power business. Okay, the first 2 points are clear. First point is what? You cannot purchase a second hand plant and machinery. Second point is what? If you are purchasing any plant and machinery, it should not be used in your office premises or any residential accommodation, but it should be used for the purpose of your manufacturing work. Understood? Second. Third point, if you are purchasing any office appliances or vehicles that are the road transport vehicles, that are also not allowed. Okay, if you are purchasing any vehicle for the purpose of for your company, it is also not allowed. So on the office appliances or vehicles, the additional depreciation are not allowed. Now, any plant or machinery to which 100% cost is allowed as deduction in any previous year under the head PGBP, there will be a section number 735. There will be a section that you will read in the PGBP in the later stage, that is called section number 35, which says that if you are incurring the expenditure on these items, okay, it is going to be the scientific research. For your idea, it is going to be a scientific research. Okay, if your business is doing the scientific research and you have done certain capital expenditure, suppose purchase the plant and machinery, there in the section number 35 you will get the 100% deduction of the cost. That if you purchase the 10 lakh rupees of the asset, then under section number 35 you will get the 10 lakh rupees as the deduction to be reduced from the profit and loss. Understood? Now if you have already reduced that particular cost, that is of the 10 lakh rupees that is purchased, you just reduce the whole amount as from the profit. So you already reduced the whole amount from the profit, so why is there any need of the depreciation? Depreciation will not be allowed now over and above the cost. You already given the cost as a deduction, then we are not going to allow now over and above. So this is what it is saying, that if you are getting 100% of the cost as allowed under any other head of the under any other section of this particular chapter, the PGVP, then it is not going to be allowed, then additional depreciation is not allowed. Understood, sir? But additional depreciation is not allowed, we understood. Now what about the normal depreciation? Array, what about the normal depreciation? This condition is set for the additional depreciation only. But what about the normal depreciation? This should be a question. But listen to me very carefully. If the cost is allowed as deduction, the whole cost is allowed as deduction, so there is no asset. Okay, there is no asset cost. So the normal depreciation will also not be allowed in that case. Understood? Clear? You already got the deduction. Shall I move forward? Okay, now printing or printing and publishing, either you are only doing the printing business or you are doing the printing and publishing business together. Okay, either you are doing only the printing business or you are doing the printing and publishing, it should be treated as a manufacturing businesses and hence eligible for the additional depreciation. Understood? Now additional depreciation is also allowed in the WDV method, not in the SLM. Just remember this, additional depreciation is only allowed in the WDV method, not in the SLM method. Okay, now forklift trucks, cranes used in the factory is not treated as a transport vehicle, so it is eligible for the additional depreciation. What are the trucks? See, if you have seen in the factories, there are small trucks which used to carry the goods from one part of the factory to the another part of the factory. Okay, these are the trucks which are used in the factory itself to load and unload the heavy items. Okay, these are known as what the forklift trucks. Okay, which is used in the premises of the factory itself for the purpose of their business. Okay, so these are not a transport vehicle, so they are eligible for the additional depreciation, because we have earlier said that any kind of a vehicle are also not allowed for the additional depreciation. So that is why they have cleared that if it is a forklift trucks or the cranes, it is used in the factory, so it is not a transport vehicle, so they are eligible for the additional depreciation. Understood this thing or not? Now, it should also be available for the assembled machinery. Okay, see, we have said that you must buy a new planter machinery. Okay, new means new, it should not be a old machinery, that is a second hand machinery. But the assembled machinery are allowed. Yes, all the parts are new. You just do what? You just, instead of purchasing a simple machinery as a whole, you purchase different parts of the machinery and assembled it, like we do now in the computers. Also, we buy the computer, the screen, the monitor of another company, we buy the CPU of another company, we buy the keyboard and mouse of another companies, and then finally we assemble it. Okay, the same way the machinery can be purchased as a whole, but if we want, so we can buy the raw material or the components of the machinery from other companies and finally assemble it. Whether that assembled machinery is also eligible for the additional depreciation? Yes, because it is a new machinery, it is not a second hand machinery. Understood clearly now? Seventh point, it is available only for plant and machinery, not for furniture or fixture. It is very much clear now from the section that you should purchase what? New plant and machinery only. The furniture, furniture, building intangibles, that are not allowed. Only the plant and machinery is allowed. So if you are purchasing the plant and machinery, then only there is a deduction of additional depreciation. Otherwise, no deduction of additional depreciation going to be there. And finally, it is going to be a one time benefit. It is only going to be one time benefit. Then I told you that there are certain concessional tax regime for the companies as well. 115 BAA, BAB. Then for the cooperative societies, BAE, BAD, all these things you are going to understand. Okay, so on that particular thing, additional depreciation are not allowed. In chapter number 9, we are going to see all these things. Okay, just for the cross referencing, it is given here in the blue. All the things which is given in the blue is going to be a cross referencing. So after completing the whole syllabus, when you read all these things, now you can interlink all those things. But it is a part of chapter number 9 where we will understand what is 115 BAA, BAB, BAD, BAE, BAC. Everything is going to be in chapter number 9, and we are going to study it in detail. Understood? So this is all about the additional depreciation. Whether you understood it not or not, can I revise it in 2 minutes? Yes. See, if you are operating in a manufacturing business, or you are in the business of generation, transmission, or distribution of the power, and you are purchasing a new plant and machinery, then over and above the normal depreciation, you are going to get the 20% of the actual cost as additional depreciation. If you use for less than 180 days, then the balance, that is 50%, is allowed in this year, and the 50% is going to be carried forward in the next year, and you can claim the depreciation. Okay, additional depreciation when will not be allowed? First case, if you have purchased the second hand plant and machinery. Second case, if the plant and machinery that you purchase is used in the office premises or the residential accommodation. Third thing, if it is the office appliances or the vehicle, that is a road transport vehicle. And fourth, of which the 100% of the asset of which 100% cost is allowed as a deduction under any chapter, sorry, under any section of this particular chapter, then also it is going to be not allowed as additional depreciation. Now, either you are doing the printing business or printing plus publishing business, they are allowed as a manufacturing business, and you can do. Only publishing is allowed. No, no, no. Only printing is allowed, but only publishing is not allowed in this particular point number 3. Okay, so if you are doing only publishing business, then it is not allowed. Okay, point number 4, which says that additional depreciation is allowed only on the WDV method, not on the S&M method. Okay, it is also available for the assembled machineries. Okay, forklift trucks or the cranes that is used in the factory premises itself are not considered as vehicle, and you can take the depreciation on it. Understood? It is for the plant and machinery, not for the furniture and fixtures, and it is only for the one time benefit, not every year. Understood? We have revised it very much easily. Additional depreciation done. Coming to the next part, which says the unabsorbed depreciation. Now, what is the unabsorbed depreciation? Listen to me. unabsorbed depreciation. Now listen to me very carefully. Suppose I have a plant and machinery which I purchased in this year, that is acquired and put to use in the same year. Okay, that is in our previous year 25-26 for rupees 500 cr. For rupees 500 cr. Can you tell me the depreciation if it is used from 1st of April 2025 itself? Can you tell me the rate of depreciation? Sir, the general rate of depreciation of the plant and machinery is 15%, and if it is acquired and put to use in the same year, that is, and also put to use on the 1st of April, that is, we are using that particular plant and machinery for more than 180 days, then it is going to be allowed as 15% of the depreciation. So 500 multiplied by 15% comes to what? 75 crore rupees as a depreciation. Yes. Now, but listen to me very carefully. My profit for the previous year, my profit for the previous year is going to be, after reducing all the expenses except the depreciation, is going to be, suppose, 60 crore rupees. Okay, now see, I we have already seen that the plant and machinery, we are ignoring the additional depreciation, you can understand it. Okay, we are ignoring the additional depreciation for the purpose of this particular question. Okay, now listen to me very carefully. What I am trying to say is, purchase the plant and machinery here, correct? 75 crore rupees of the depreciation is there, and we have studied that claiming of the depreciation is what? Mandatory. Claiming of the depreciation is mandatory, but understand the problem. Profit is 60 crores. If I reduce the depreciation from this, if I reduce the depreciation from it, that is 75 crore rupees. So there is a loss of 15 crore rupees. There is a loss of 15 crore rupees, means this particular depreciation, which was 75 crore rupees, is only absorbed. The only 60 crore were absorbed in the profit. The balance 15 crore rupees of the depreciation is also unabsorbed this year. Okay, because the profit is 60 crore itself, my depreciation is 75. That means only the profit, that is of 60 crore rupees, can absorb the depreciation of 60 crore rupees. Okay, so the balance 15 is unabsorbed this year. That is why this loss is coming of the 15 crore rupees. So the government said that, see, the claiming of the depreciation is mandatory now. So we cannot say that this is lapsed. This is lapsed. No, we want that you claim the depreciation. We cannot say that it is a loss. Okay, it is a loss, so do not give the depreciation, do not give the tax. No, we can't say that. So what you can say, the government said that this 15 rupees of the unabsorbed depreciation, this is what? Unabsorbed depreciation. Why? Because only 60 crore, the profit has the power to absorb only 60 crore rupees, but the depreciation is of 75. That means the 15 crore rupees in is unabsorbed. So this 15 crore rupees, the government said that you can carry forward, you can carry forward it to infinite number of years, into it's to infinite number of years, that any number of years, if it may be 20 years, 30 years, 50 years, 80 years, till when this particular unabsorbed depreciation is not absorbed, keep carry forward it and keep taking the deduction, keep carry forward it and try to absorb in the next year. If it is absorbed, very good. If it is not absorbed, okay, carry forward it. If it is half absorbed, okay, very good, the balance to be carry forward. Okay, but you have to claim the depreciation for sure. Understood this particular thing, what is unabsorbed depreciation and why it is done. Okay, now what should be the, like, in the next year, come to the next year, that is previous year 26-27, that is my next year, correct? Now I have unabsorbed depreciation of previous year, suppose previous year 25-26, that is of 15 cr. Earlier one, I even have depreciation, I even have depreciation of previous year 26-27 of 60 cr again. profit of previous year 26-27, suppose it's going to be now 200 crore rupees. Okay, what should be now the sequence? What should be now the sequence to set off? Either I should adjust, either I should adjust this 15 crore rupees first from this 200 crore rupees, or either I should adjust this 60 crore rupees from the 200 crore rupees. In this example, either you absorb first 15 crore rupees, then 60 crore rupees, it is okay because it is going to be absorbed. But what should be the logic? What should be the logic? Understand it very carefully. See, claiming of the depreciation is mandatory. So it should be the first priority to absorb. It should be the first priority to absorb. So first, from the profit, I should reduce the depreciation for the current year. I should reduce the depreciation of the current year, that is going to be 60. Then it is only for 140. From that only I am going to reduce other things. Understood? Now the same sequence is given here. Okay, understand it very carefully. Now what it said that, see, only one thing will additionally come, we'll see. Unabsorbed depreciation can be carried forward indefinitely and can be set off under any head except the salary. Means the set off can be done of the unabsorbed depreciation from any head, just except the salary. From salary you cannot adjust the, you cannot set off the unabsorbed depreciation. Okay, if you are having the salary and also having the business at the same time, this is not usually practically not allowed, okay, and not feasible. That is why it is said that if you are running a business, then there should be a possibility that you have the unabsorbed depreciation, so you can carry forward it. You can indefinitely, you can do what, infinitely you can carry forward it, set off it, but except the head salary. Now in the next years, while adjusting the brought forward unabsorbed depreciation, that is from the last year, priority of setup should be, first priority should be what, current year depreciation. Why? Because it is a mandatory. Second, now brought forward business loss, the last year brought forward business loss are there. What other brought forward business loss? Suppose in the previous year 24-25, okay, my profits were, suppose, 100 cr, depreciation was only 15 cr, and the other expenses are what, rupees 100 cr, or let me say other expenses are only 90 cr. Okay, now first thing is what, to claim the depreciation, because it is mandatory. So what we did, 100 minus 15. Okay, so the depreciation is absorbed. Yes, now what is left, 85. But out of 85, 90 rupees is my other expenditure, that this 5 crore rupees which is left is my business loss, is my business loss. Okay, it is not unabsorbed depreciation. Why it is not the unabsorbed depreciation? Because the depreciation is already absorbed in the profit. Now the profit still is having 85 crore rupees, but the other expenses, due to the other expenses, this loss is coming, not because of the unabsorbed depreciation, because of the depreciation, but in this particular case only because of the depreciation, the 15 crore rupees loss was coming. That is why it was known as what, unabsorbed depreciation. I hope you understood this particular point. So what they are saying, that, see, first thing, you have to set off the current year depreciation because it is mandatory, second is a brought forward business loss. Why, sir, brought forward business loss? Why not unabsorbed depreciation which is brought forward? Because the brought forward unabsorbed depreciation can be set off and carry forward to infinite number of years. Yes, but the brought forward business loss, na, they can only be set off and carry forward for 8 years only. So these are they have the lesser time period, so they are adjusted first. Like first you set off this, first you carry forward it. Okay, the balance, if again you have some balance in your profit, then adjust the unabsorbed depreciation. Understood? Because if you first absorb the unabsorbed depreciation that is brought forward from the previous year in the current year, then there could be a loss, there could be a less profit. okay, there could be less profit remaining in your books, okay, and now you try to absorb the brought forward business losses as well, then there could be a chances that it is not absorbed in the 8 years, okay, it is not absorbed in the 8 years. So for that purpose, the brought forward loss left after the 8 years as well, it is now lapsed. So it has a limited time. Now it has a limited time. That is why it is kept on the second priority. That brought forward business loss to be set off first, and then afterwards, if any profit is left, you can carry forward instead of the brought forward unabsorbed depreciation. Tell me this whether it is very much clear to you or not. Clear? No. Unabsorbed depreciation can be set off even if the business to which pertains does no longer exist. If the businesses no longer exist, okay, then you can also take the deduction of the unabsorbed depreciation. You can file the return and you can take the deduction. Okay. Now, unabsorbed depreciation shall be carried forward even if ROI is filed after the due date of filing of return. That means that you will find, you will study that there are certain deductions, there are certain expenditure whose deductions will not be allowed if you file the return of income after the due date of filing of return, okay, but there is an unabsorbed depreciation which will be allowed even you file the return of income after the due date, or even if you are not filed the return of income now, then also it is going to be allowed. Why? Because claiming of the depreciation is mandatory. So if you file the return after the due date, we do not care. If you do not file the return of income, we do not care. You will get the deduction of unabsorbed, you will get the deduction of the unabsorbed depreciation. So but the point number one is not very much clear, that the unabsorbed depreciation can be set off even if the business to which it pertains no longer exists. Suppose I have a unabsorbed depreciation for the previous year 25. Let me write here, okay. Sorry, come here. Just a second. Yes. Suppose I have a, for the previous year 24-25, I have a unabsorbed depreciation. For how much? 25 CR. Suppose. Understood? Easy. Now, in the previous year 25-26, my business was going on, but due to sudden any event, 31st of October 2025, my business shut down, closes, okay, or dissolved. But I did the business till 31st March, 31st of October 2025. Yes, so I'll file the return of income in the AY 26-27. Yes, but here the business is not existing. My business is not existing. Then also, whether can I claim the unabsorbed depreciation of the last year? Yes, I can claim it. Tell me whether now you can understood this particular first point as well, that UAD, that is unabsorbed depreciation, can be set off even if the business to which it pertains no longer exists. If it is not even existing, then also whether you can claim it? Yes, you can claim it. Understood clearly? Shall I move forward now? Yes. Now, what is a written down value? That is a WDV. That is section number 43C. Sorry, 43.6. See, in the class 11th, you have seen that there is some cost minus depreciation will give you a WDV. That is a carrying amount. Okay, the carrying value of the particular asset. Okay, this is what it is said that. See, cost minus depreciation, which is actually allowed, that UAD shall be deemed to be actually allowed. What is unabsorbed depreciation shall also be deemed that it is actually allowed to you, because it is going to be allowed now. So actual cost minus, that is the cost of the asset, minus the depreciation which is actually allowed to you, will give you the WDV. This is the same thing that you have studying from the class 11th. Understood? Now what they are saying, that the carrying value can never be the negative, because the cost minus depreciation, it should be the positive figure. Okay, it should be the positive figure only. It can never be the negative figure. Now WDV in the hands of successor, that is WDV in the hands of party succeeded to. Okay, what does it says? Suppose there is a business of your father, okay, which was in his name. Now the business is succeeded to you, okay, he is now retired, okay, and he transferred the business in your name, okay. So listen to me very carefully. So whatever the WDV in his hand, na, what when he was the owner, what is whatever the WDV in his hands is going to be the WDV in your hands. Okay, the same. You cannot say that it is a new machinery. I am the new owner now. Everything is going to be new. Okay, I will run the company, I'll run the business on my own way, so it is going to be everything new. No, whatever the WDV in his hand is now going to be the WDV in your hands, and now you have to depreciate accordingly on that basis itself. You cannot say that it is a new machinery, or I want to say that it is not depreciated that much, the cost is different, something is different. You cannot do so. So whatever the WDV in his hand is going to be the WDV in your hands only. Okay, now where the income of the assessee is derived partly from agriculture business and partly from business. For computing WDV, the total depreciation shall be computed as if the entire income is derived from the business, and such depreciation shall be deemed to be depreciated actually allowed. This is going to be studied with rule number 8. What it says that usually the rule number 8 we'll see in this particular chapter itself, whenever we'll see after section number 33 AB. Okay, it says that whenever you have a agriculture income and a partly the business income, okay, you are earning the both the incomes. So we will assume that you are not doing any agriculture income. So whatever the depreciation we are going to claim, okay, so entire depreciation we can claim it from the business income. Okay, as if we are assuming that there is no agriculture income, everything is going to be the business income. So you can take the deduction from the business income. Okay, understood. It will more in detail in section rule number 8. Understood. Now, wherever it is, like I have said you so many times, wherever it is written in the blue, okay, it is going to be interlinking. It is going to be interlinking. So point number 4, that is section number 47, is going to come in the section number 47 of the capital gains, is going to be capital gains. So we will see there. Okay, now it is the same thing. Like if you want to study or if you want to read, it is very easy, that if you transfer the asset by the unlisted public company or a private company, okay, whether it is an unlisted public company or private company, and you are transfer the block of the asset, you are transferring the assets from the unlisted public company or the private company to LLP. Now the company is becoming what? Firm or LLP. So this particular transfer is usually exempt under the capital gains, okay, on which it is a transfer, so on which the capital gain does not arise. So this is the interlinking. But what it is here for the purpose of this, for the purpose of WDV, what it is said that, it is said that whatever the actual cost in the hands of LLP. Now LLP is the owner, na. Earlier the owner who? Earlier the owner was the public company or the private company, the unlisted public company or the private company. Now the owner is LLP. So what should be the actual cost in the hands of the LLP? It should be the same. The WDV in the hands of such transferor company. Whoever transferred those assets, whatever the cost, whatever the WDV in their hands is now going to be the WDV in the hands of LLP. On that WDV, they are going to claim that depreciation, as simple as that. So, but it is an interlinking, that if there is a transfer from unlisted public company or private company to LLP, it is going to be exempt from the capital gains. That was the interlinking. But for the purpose of PGBP, do you understand this much part? This is relevant for the PGBP. Clear? Done? So if you want to take a snapshot of it, written down value, what it is, just read it once and grasp it. Okay, it is more important. Just take a grasp, just take a read of it. Then we shall be moving ahead to the most crucial section. The most crucial section, that is actual cost, section number 43, subsection 1. For the exam perspective, for the exam perspective, this is the only thing that you need to understand. For the exam perspective, this is the only thing, this particular 3 lines they usually ask. But there are certain explanations to it as well, that is actual cost. In some special cases they have given only 13 cases, only 13 cases, but there are some 4A, 7A and 1A. So 13 plus 3, that is what 16 cases they have given. Okay, there are some special cases, and they said what is the actual cost of the asset in these cases. But usually we see the ICA usually do not ask the questions from this explanation part, but it is in your syllabus, so you need to understand it very carefully. Okay, okay, so there should be some section that we'll understand in more detail when we understand those sections, like section number 35 we'll see. So everything is interrelated, everything is interrelated, and I have done all those things interlinking for you. So whenever you will read the chapter after the end of your syllabus, then it is going to be super ultra easy for you to recall and remember to interlink or link each and everything of your syllabus. Okay, now coming to the point, what it said that it means, what is the actual cost means? The actual cost of the asset to the assessee as reduced by the portion of the asset which has been directly or indirectly met by any other person or the authority. What does it says? That it says that what is the actual cost of the assessee of the asset? We have seen that now. See, in the purpose, for the purpose of WDV, we have seen that actual cost minus depreciation actually allowed. Yes, in the additional depreciation as well, we have said that 20% of the actual cost. So what does actually the actual cost means? So it says that, suppose, listen to me carefully, cost of the machinery. I am purchasing a machinery and to which its cost is what? Suppose 100 lakh rupees. 100 lakh rupees means 1 crore rupees. Yes. Out of this 100 lakh rupees, government give me a subsidy. Subsidy by government. Okay. How much? Suppose 10 lakh rupees. There is also a subsidy given by a NGO. How much? 10 lakh rupees. Okay, the two subsidies or something else given by some other person which reduces my cost to 80 lakh rupees from my pocket only this 80 lakh rupees gone. From my pocket only 80 lakh rupees gone, because the 10 lakh rupees and this 10 lakh rupees are received by the government or the NGO. Now this 80 lakh rupees is known as what? Actual cost. So whatever is gone from my pocket is going to be the actual cost to me, because the MRP of the goods or the machinery is 100 lakh rupees na. But what is the cost to me? For me the cost is only 80 lakh rupees, because the balance 20 lakh rupees was given by someone else. So it is not my cost. My cost is only what? 80 lakh rupees. This is what it is said, that it means the actual cost of the asset to the assessee as reduced by, okay, the portion of the cost which has been directly or indirectly met by any other person or authority. If anyone is giving the price of it, so I will reduce it. So whenever I'll get the subsidy from the government or any other person or some any other grants, so we are going to reduce it. Whatever is going from my pocket is only going to be the actual cost. But listen to me very carefully. They said certain condition, that if you are if the assessee incur any expenditure for acquisition of any asset and the payment made to a single person in a single day, otherwise than through a account pay check, means if you are incurring any expenditure for acquisition of any asset and you are making any payment to whom? A single person in a single day, the both the conditions should be satisfied to a single person as well as in the single day. Okay, otherwise then by account pay check, demand draft, ECS. Okay, so if you are paying by other than these three modes, then this amount is exceeding 10,000 rupees, then it should not form part of the actual cost. What does it mean? That suppose if you are purchasing the asset that is of 80 lakh rupees, okay, purchasing from ABC Limited. Understood. Now to ABC Limited, suppose I paid 10 lakh rupees in cash and rupees 70 lakh rupees as suppose check. What is a check? It is a account pay check. Account pay check. Okay. So I have paid this 10 lakh rupees in cash. Whether it was allowed? No, because to a single person in a single day, I cannot pay exceeding 10,000 rupees in any other form other than account paycheck, demand draft, or ECS. But I have paid 10 lakh rupees as cash, so it will not such expenditure. That means what? Such expenditure. That means that 10 lakh rupees shall not form part of the actual cost. For me now, actual cost is going to be this only. This is actually only the actual cost. This 10 lakh rupees will not the actual cost because it is not as per the provisions. So if you are paying other than account pay check, demand draft, or ECS more than 10,000 rupees for any expenditure in a single day to a single person, then it is going to be not allowed. But suppose this 10 lakh rupees was paid to the same ABC Limited, but not in a single day. Daily it is only 99999999999 and keeps going on, keeps going on, and keeps going on. Whether now, what is my actual cost? Tell me that. What is my actual cost? Now the actual cost is going to be what? The actual cost is going to be whole 80 lakh rupees. The actual cost is going to be whole 80 lakh rupees. Why? Because now no condition is violated, because I am not paying more than 10,000 rupees in a single day. I am paying to a single person, that is correct, but not in a single day. Arey, correct or not? Understood the nitty gritty of this particular section? Actual cost. So you cannot pay more than 10,000 rupees in cash or any other mode other than account pay check, demand draft, or ECS. These three methods are allowed. Other than all these things, it is not allowed. But UPI, other things, it is allowed. Okay, means the online methods are allowed, but this cash method, normal check are also not allowed. Crossed check are not allowed. Account pay check are allowed. See, there are checks. Listen to me very carefully if you do not know. This is a check. Okay, this is the check. If I do this only, this is known as what? Cross check. It is not allowed. If I do only this is a cross check which is not allowed. Okay, now listen to me very carefully. I have given a check. Okay, now the check is small. uh Let me show you now. Yes. Now I have given a check. Whether it is allowed? Not allowed. Why it is not allowed? Because it is not an account paycheck. So what is a account paycheck? So then what is a account paycheck? So account paycheck is what? Listen to me very carefully. This is a check. We will do this and we will write account pay. If we do this, then it is allowed. This is a account paycheck. This is allowed, which is a account paycheck. Is this point clear to you? This is a crossed check only and it is not allowed. It is a normal check, not crossed or not account pay. It is not allowed. Okay. This is a normal check, not allowed. This is a cross check, not allowed. This is a account pay check that is going to be allowed. Clear or not? Tell me this. Done? So this point is clear to you. Now coming to the actual cost where this calculation is required. But let me keep this calculation for you for the purpose. Hold. Because something is to be taught to you. If you want to read it, you can read it because these are very simple things. See, suppose cost of asset. What is a WDV? Actually, what we are doing what? The actual cost of the asset. We are doing what? Actual cost of the asset, that we have already seen that the cost is this and the subsidy we received is this. So with the actual cost is going to be 20 lakh rupees. But there is a concept. So let me tell you, there is a concept that whatever the expenditure you have done to put the asset in the put to use condition. Whatever the asset you are, whatever the asset you have purchased, and whatever the expenditure you have incurred to to apply the machinery or to apply the asset to be operational, then all those expenditures are capitalized. All those expenditures are capitalized. So this is what it is said, that if you have done the cost of asset, the asset cost, it is there, the installation charges, transportation charges, trial and charges, and the taxes and duties, that is the GST, if the ITC is not available. Okay, only when it is not available. And interest on loan taken for acquisition of the asset. If you remember the borrowing cost, India is 23, that the interest on loan taken for the acquisition of the asset is also going to be up to the date of put to use, it is going to be capitalized. And also there is a question in India 16, if you remember. Okay, there is a question of the borrowing cost. Okay, all these to be added up, correct, reduced by the any amount that we receive from the trial run or the subsidy or government grant, that we have already seen that these kind of a subsidies to be reduced, because these are not the actual cost. Now the finally we will get the actual cost, finally we will get the actual cost. Understood. So this is nothing, what it is. See, the cost of acquisition. Okay, whatever the expenditure we have incurred to put the asset in a ready to use condition, all those expenditure are going to be capitalized in the asset. Then whatever the amount that we have received, okay, to be reduced, and now you will get what, actual cost. This is what we have already seen, this is what we have already seen. Correct. Now coming to actual cost, coming to the special cases of the actual cost, it is important to understand. Just it is important to read it once, because ICA usually does not ask the question from these explanation, but it is important. ICA papers are, and the trends are changing day by day, so you cannot say that this particular question will not be asked. They can ask anything from it. Okay, so be prepared for each and everything, be prepared for the worst cases. Okay, now move on. Explanation to section number 43.1, that is the actual cost in special cases. First point, asset previously used for scientific research now brought into the regular business. You will see under section number 35 that if you use the business, if you use any asset for the scientific research, okay, section number 35, that we have already studied in additional depreciation concept, that 100% of the deduction is allowed to you. Correct, 100% of the deduction is allowed to you. So whenever you are using the asset in the scientific research business, for which 100% is already allows that deduction, now you are carrying that scientific research asset into your regular business, that is a normal business apart from the scientific research business. So whether you will get the another cost from which you will reduce again depreciation, no, the cost will be what, now the cost will be zero, because you have already claimed what, the depreciation. You have already claimed all the depreciation. Now you have already taken 100% of the deduction of that asset. Now the asset value is zero. Now if you brought that particular asset in the regular business as well, you will not get any kind of a depreciation, because your actual cost is going to be nil as per section number 43.1. Now actual cost is going to be nil, because the deduction already claimed under the section number 35, the whole deduction that you have already claimed. Understood? That is why the actual cost is going to be nil. If the actual cost is going to be nil, so the additional depreciation is going to be nil. Okay, where the additional depreciation is not allowed usually, and the normal depreciation is also going to be nil. What I said in the additional depreciation, that the normal depreciation will not also be allowed. This is the reason why the normal depreciation will not be allowed in the case. Point number one is clear to you or not? Tell me this. The point 1A was already left by me under section number 28. Was already left by me. See, stock converted into capital asset and used for the business or profession. Come to section number 28. This is the point number 12. This was kept hold by me for capital gains. So first A is also kept by me under the hold. Okay, read in CG. Read in capital gain, and you will easily relate it everything. It is my responsibility. I'll make you come here. Okay, and then we'll interlink all those provisions, that after reading the particular provision of the capital gain, see, this part is complete, this part is complete. Okay, now, asset acquired by way of gift, will or inheritance. If your father gives you some asset, okay, if your father gives some gift, or in will or in inheritance some asset, and you put that particular asset for your business, so whatever the actual cost to your father, less depreciation allowed to him. Okay, he suppose he purchased that particular asset for 10 lakh rupees. Now what is the depreciation allowed to him? Now what is the WDV till date? What is the WDV as on today when it is received by you as a gift will or inheritance is going to be your actual cost, on which now you are going to take the depreciation. Now suppose asset acquired with the intention to claim higher depreciation. Asset was only of rupees 10 lakh, but you acquired it for 20 lakh rupees, because if my actual cost is higher, I'll take the higher depreciation. So if this was your intention, so the intention was nullified. So in that particular case, the amount of actual cost is going to be determined with the AO, determined by the AO. AO will determine what should be the actual cost of your asset, and AO before deciding it will consult the joint commissioner in that case. And normally usually it they usually take what fair market value of such asset, because the fair market value was 10 lakh rupees, but to claim the higher depreciation you showed for 20 lakh rupees. That was wrong, so they'll take 10 lakh rupees as the actual cost, and on which you can claim the depreciation. But your intention was nullified, that is why AO came into picture, and with the help of the joint commissioner, with the approval of the joint commissioner, they are going to decide. And usually they used to decide what fair market value of those assets. So whether point number 1, point number 2 and point number 3 are clear to you or not, tell me that. Are these clear? No. Fourth point, reacquisition of the asset sold. What it is done, see, there is A, there is B, there is C, or suppose there is no C. You sold the asset to B, and again the asset, uh, the same asset is sold by B to A. What you have done, you have reacquired the asset sold. So in that particular case, what they are saying, that lower of WDV at the time of sale means whenever A sold the goods to B, this is the first step now. So what is the WDV in the hands of A? Okay, take that. Or actual price of reacquisition, what is the actual price of which A pays to reacquire the asset? Whichever is lower is going to be the actual cost. Whichever is lower is going to be the actual cost. Suppose the when Mr. A transferred the asset to Mr. B, there is a WDV of 10 lakh rupees in his books, but he acquired it in 20 lakh rupees. Can you find the feel of this particular point number 3? Can you feel point number 3? Because the reacquisition was made to claim the higher depreciation. There could be a malified intention or not. Yes, that is why they have said that the WDV at the time of sale, that is 10 lakh rupees only, and you have again reacquired it. Now you have reacquired it in 20 lakh rupees. This is wrong. We'll take only 10 lakh rupees, because this is the actual cost in your hand. This is the actual cost in your hand. Okay, so the malified intentions are not workable here. Coming to point number 4a, asset purchase and leased back to the same person. In the particular point number 4, we said that we are reacquiring the asset sold. But here it is what it is done, what whatever the asset we are purchasing it, we are leasing back to the same person. Okay, now see, for point number 4 was from the angle of A, was from the angle of A. That A sold something to B and again purchased from the B. Purchasing was there. Point number 4 is saying that if I, from the point of view of B, that if I purchase something from A, I am not reselling, I am not resold it to B, A only. I am not reselling it to A. Why I am not reselling it? Because if I resold it, then A will fall under point number A. Under, sorry, point number 4. So to override the point number 4, they are what saying, they are saying that we are not reselling to you, we are now leasing it back. Now B is not reselling the asset to the A, it is just providing the asset on a lease basis. Understood the difference between point A and point 4a? Sorry, point 4 and point 4a. Understood? Now what it said, that the WDV to the previous owner, that is previous owner, who is the lessee, that is WDV in the hands of A self. That is point number this. Because actual price of the reacquisition is not available now, because it is not actually required, it is not acquired, so it is going to be zero. And so the balance is what? WDV at the time of sale itself. That is why they have taken the WDV at the time of sale. Okay, understood? So point number 4 and 4a are usually the same. Okay, because in the 4A there is no reacquisition, so the B part, that is actual price of the reacquisition, is not here. So they have only take what, WDV at the time of sale, that is the WDV of the previous owner, that is A only. Understood? Now what it says, that section 4A overrides section number 3, explanation number 3. Explanation number 3 said what? If you are claiming, if you are acquiring the asset with the intention to claim the higher depreciation, in that particular case, what, AO will come and determine based on the approval of JC. Here as well we are doing the same thing to claim the higher depreciation, but here what they say, the WDV of the previous owner is going to be the final answer. So 4A overrides the explanation number 3. So if there is a case to claim the higher depreciation, the asset was purchased and leased back to the same person for the purpose of higher claiming of the higher depreciation. So the point number 3 and point number 4 both will override, sorry, both will clash. So in that particular case it is said that point number 4A will follow, that is WDV of the previous owner is going to be the actual cost of the asset. Understood? Shall I move forward? Yes. Now, building was used for other purpose, now brought into the business. Suppose I have some building. This particular building is mine in my personal name. Okay, I'm using it for the personal purpose. But now I'm using this particular building in my business. I'm transferring the building to my business. Okay. Now I was first using it for my personal purpose. Now I'm using it for the business purpose. So for my personal purpose, if I was using it for the personal purpose, do I get the depreciation? Tell me that. Do I get the depreciation if I was sold? If I was using it for the personal purpose? No. To claiming the depreciation, there was a condition that it should be used for the business or profession, but it was not used. But now from onwards it is going to be used for the business purpose. So they are saying that what should be the WDV, what should be the actual cost of the particular asset of the building. It is only for the building. Listen to me very carefully. It is not for the plant or machinery, it is not for furniture fixture, it is only for the building. So they said that actual cost for me, what at what price I have purchased it, reduced what, notional depreciation. What it is notional depreciation? Because if I was using it for the personal purpose now, so no depreciation was allowed, so the actual cost was there only. But if it is we are using it for the now business, so we want the WDV of the asset now. So they are saying that assume that it was usually started from the very beginning, it was using for the business only. So what is the current depreciation rate? Means today what is the depreciation rate? Based on that, reduce the depreciation for those years. Okay, and what is going to be the WDV is the actual cost of that particular building. Understood? Easily, very easy. Because when I was using for the personal purpose, the depreciation was not allowed to me, but now I want to take the WDV now. So I'll assume that if this particular building was used since day one for the business purpose, what should be my WDV? So I'll calculate the WDV assuming that this is the current rate of the depreciation of the building, that is what, for the building usually what, 10%, if I say usually 10%. Okay, for the residential purpose it is 5%, usually the 10%, if I can say. Okay, I will remove the depreciation from it based on the 10% for those number of years. Whatever the WDV will I get is going to be my actual cost. Tell me, this is clear? Now, coming to point number 6. Capital asset transferred by a holding company to 100% subsidiary company or 100% subsidiary company to holding company. Okay, if the asset is transferred by a holding company to 100% subsidiary company or 100% subsidiary company to holding company, this transfer is also exempt under section number 47 4 or 5 in the capital gain. So this is not a transfer and the capital gain will not be attracted. But the WDV or the cost in the hands of transferor is going to be the WDV or the actual cost in the hands of the transferee. Understood? Who is transferring? who is transferring. Suppose in this first example, holding company is transferring to the 100% subsidiary company. So the WDV in the hands of holding company is going to be the actual cost in the hands of 100% subsidiary company, or the vice versa. So the cost or opening WDV or to the transferor who is transferring the asset is going to be the actual cost, is going to be the actual cost. Same point number 7, same point number 7a. See, if you are transferring by amalgamating company to amalgamated company, or demerged company to resulting company, okay, same thing. WDV to the amalgamating company means who is amalgamating, who is removing, okay, and the WDV to the demerged company which is going to be removed from now. Okay, so the transferor company, the from where the asset is going to the another company, so who is transferring, the WDV in their hands is going to be the actual cost in the new company. Whether all these point number 1a, sorry, 1a is left, 1 2 3 4, 4a, 5 6 7, 7a, done easily. Any confusion, anything you can ask. Okay, now I am moving forward. Point number 8, that is asset acquired out of borrowed fund, means I have taken some loan of which I have acquired some asset, like specific borrowings, Ind AS 23, remembering. So interest up to first put to use will form part of the actual cost. I have already discussed here, I have already discussed this here. All the expenditure till the date of put to use is going to be capitalized in the actual cost, whether it is clear to use point number 8, but I want to discuss some further points in the point number 8. Okay, so coming to the explanation 8, that is notes related to the interest loan taken for acquiring the asset. Now interest up to the date of first put to use to be added to the actual cost. Okay, when it is first put to use, it is going to be added in the actual cost, that we have already discussed. But after the date, after that date, it is allowed as a revenue expenditure, and you can claim the deduction as a normal expenditure. It will not be added in your cost, but you can take the deduction from the PGBP, the PNL part. Okay, whether understood or not. So see, if it is up to the date of put to use, then it is going to be added in the actual cost, and apart from it, when it is after use, after put to use, then it is going to be a revenue expenditure, and you can claim the deduction there. But the sale price of the product generated from runs, okay, shall be reduced from the such asset. What does it say? That suppose I purchase the asset, I purchased the asset, but I want to check it whether the particular asset is working fine or not. So I have done a what test run. I have done the test run. So from the test run, there is some products manufactured. From the test run, there is some products manufactured, and I sold that particular product. I sold that particular product. So whatever the selling price, whatever the sales price of that particular product is now reduced from the actual cost, because I take out the cost, I take out the benefit of that particular asset before purchasing it. Okay, so it is before purchasing it, I recovered some cost by selling the product from the test run. That is why it is reduced, and that is why we have taken this amount received on the sale of trial run products. Then it is also going to be reduced, because it is not my actual cost, because whatever the actual cost, I have recovered something, I have recovered something, that is why it is reduced. Tell me whether it is clear to you, point number 8 as well. Yes. Point number 9, GST custom duty as well. I have said that on which the ITC is not going to be allowed, is going to be the part of the actual cost. If the ITC is allowed to me, then it is not going to form part of my actual cost. So duty in respect to which ITC claim are not allowed will form part of the actual cost. Okay. Now, point number 10, government grants or subsidy. If I receive the government grant, if I receive the subsidy, then it will reduce the actual cost if it is related to the asset. If it is related to the asset, to purchase that particular asset, if I get the government grant, if I get the subsidy, then it is going to be reduced from my actual cost. But there is a catch. Come to explanation number 10. Notes related to the government grants, explanation number 10. What does it say? That if any subsidy, grants, cash incentive, duty drawbacks, waiver, etc. by CG or SG or by any authority or body, okay, shall be treated as income under PGBP. What does it mean? Listen to me. If any grant, subsidy, cash incentive, duty drawback, waiver, either from the central government or the state government or any authority, shall be treated as PGBP other than expansion number 10 means for the asset. If the subsidy, if the grants, if the cash incentive, duty drawback, waiver received by CG, SG or any authority for any expenditure to be done, not for acquiring of the asset. See, point number 10 is doing what? Point number 10 is saying that if it is related to any asset, then reduce it from the cost. But if it is done for any expenditure, if the, like we are giving you the we are giving you the subsidy, the government is saying that we are giving you the subsidy, you can use this particular subsidy in paying the salaries of your employees. This is based on the expenditure. So whether this will reduce the actual cost of the asset? No, because it is not related to the asset. It is going to be my PGBP income and it is going to be taxed. It is going to be taxed. Okay, now coming to the next point. Any subsidy grant received by the trust or institution which is established by central government or state government as a corpus fund from central government shall not be treated as income. What does it mean? If there is a trust or institution which is established by whom? Either central government or state government, does not matter. But who funded that particular trust? Who funded the trust? Central government funded the trust, not the state government. Only central government funded the trust. Then it is not going to be the income. Then it is not treated as an income. Okay, but if it is funded by the state government, if it is funded by the state government, then it is going to become your income. Understood? Now, point number 3, the last point. Above provisions are not applicable on LPG subsidy or other welfare subsidy of the individuals. For the individuals, we are providing, the government is providing the LPG cylinders at the subsidized rate, or the other welfare subsidies as well, like the other various welfare subsidies schemes are given by the government to the individuals. So on those things you cannot say these are the LPG cylinders are given to you, these are the subsidies, so it will be added in your income. No, that is not their business. That is not their business. So for the individuals who is getting the LPG subsidy or the other welfare subsidy, they are getting in their individual capacity, not in the capacity of the business. That is why they are not applicable. This particular provisions are not applicable to them because it is not related to the business. Whether it is clear? So point number 10 is also clear to you. Shall I move forward? Now, if the asset brought into India by NR for use in his business or profession. Now there is a NR, that is a non-resident, who brings the asset in India to use in the business or profession. Okay, there is a NR whose business is in India. Okay, so he sends some asset which was used in the uh, uh, foreign, okay, for the use in the business or profession, that is in India. That is asset brought into India by the non-resident for use in the business or profession. So so whatever the actual cost is there minus rate calculated at the rate in force as if the depreciation was rate in force as if the asset was used in India from the date of acquisition. Okay, so we'll say that whatever the actual cost is to the NR, the NR purchased that particular asset for suppose 100 lakh rupees. So what is the depreciation as per the rates there? Okay, suppose it was purchased in 24-25, or let me say 23-24, but now it is coming in India in the previous year 25-26. So suppose what is the depreciation rate for 23-24? It says that suppose 20 rupees, okay, 20%. Now suppose for 24-25, what is the rate? Rate changes to 15%, might be. Okay, suppose now in this year 25-26, what is the rate? Okay, suppose 10. So this is going to be my deduction. This is going to be my the final, what is the amount, is it is going to be the actual cost. So see, in point number 11 and in point number 5 there is a difference. In point number 5 and point number 11 there is a difference. In point number 5 what it is said that if resident individual is using the building for another purpose, whether they have said resident or not, only the building, they have said only the building, resident non-resident not said. if we are using that particular building for any other asset, now it is coming into the business, so they said that reduce the notional depreciation with the current depreciation rate, whatever the depreciation rate is ongoing, now reduce the whole year depreciation from that particular rate itself. Okay, but in point number 11 what they are saying, if the asset is brought into India by a non-resident for the business or profession, they are saying that actual cost to be reduced by the depreciation, assuming that the rate in India from the date of acquisition, that is the depreciation of respective years will be taken. If in the in if in one year it is 20%, take 20%. In the next year, if it is reduced to 15%, take 15% of the depreciation. In the next year it reduced 10%, take 10%. Okay, again suppose in the next year it increases to 25%, take 25%. So based on the year of the based on the depreciation rate of the respective year, take the depreciation, and then whatever the final amount comes for your previous year, it is now going to be your actual cost. So there is a difference in point number 5 and point number 4. Understood? Now, what it says that point number 12. Any capital asset acquired under corporatization of RSE. That means if the RSE is what RSE is what recognized stock exchange is what a EOP or a BOI. Okay, if it is converting to a company, if it is converting to a company, so the cost of WDB in the hands of AOP BOI. The same logic of 6, 7 and 7, 8. Tell me that 6, 7, 7 is the same logic applies here as well for point number 12. Correct? Now, last point. What it says that actual cost definition. See, actual cost allowed as deduction under section number 35 AD. And capital asset, it is also like, if I have to say na, we will understand it in 35 AD. We will understand this particular point in 35 AD. So 35 AD, point number 13 is left and point number 1A is left. Rest all the points I have taught you. Rest all the points I have taught you. Only point number 1A and point number 13 is left. Understood? Shall I move forward? Shall I move forward to depreciation under SLM method? Tell me, shall I move forward to a depreciation method? Yes. Now, depreciation under the SLM method. I have said you know the depreciation method are two. That is, first is the WDV method, second is the SLM method. WDV method is applied to rest of the companies, but there is only one kind of a company, okay, one category of a company on which there is an option. Either you want to choose the WDV method or you want to choose the SLM method, you can choose. But this option will not be given to any other kind of the company. So who are those lucky companies? For those, the WDV or SLM is a choice. So these are the company which are engaged in the business of generation. Either you are in the business of generation of power or you are in the business of generation and distribution of the power. Only distribution are not covered. Either you are in generation of power or generation and distribution of power. Only distribution is covered. No. So if you are only in the business of distribution of power, not allowed. If you are generating the power, allowed. If you are generating along with distribution of the power, allowed. Only distribution is allowed or not? No allowed. Okay, can claim the depreciation according to any one of the following method, whether it is SLM or WDV, it is their choice. Now, such option is to be exercised before the due date of filing of return. So before the filing of return, you have to choose which method is going to be applied by you, whether it is SLM or WDV. And whatever you have applied once, it to be applied for all subsequent years. So apply it very carefully. In the first year, if you applied the SLM method, then it is going to be applied for the rest of the year is going to be SLM only. You cannot shift to WDV. If you have first used the WDV method, then for all the balance year you are going to get the WDV method only. You cannot choose the SLM now. Okay, so it is a one time method. You have to choose. If you choose once, then you cannot change it. Okay, now in case the or for the SLM method, on discarding the asset, means when the asset is sold or when the asset is scrapped, okay, the terminal depreciation is deductible or balance sheet charges taxable. What it is, we'll understand in the example. Okay, in this example we'll understand it. Okay, or the point number C, Under SLM method, the 58 capital gain shall also apply. What is 50A? We'll see in this particular, sorry, section of 50. We'll understand 50 and 58 we'll see in capital gains. Okay, that is why it is written in, blue, because capital gains we'll see that. Okay, in the capital gains we are going to see that. What is section number 50A? Understood. It is written in blue because it is an interlinking. So depreciation under SLM method, the basic concept is clear to you that if you are a business of generation power or generation and distribution of power, then it is going to be allowed. The same thing, remember, the same thing we got in the additional depreciation. If you're not remembering, let me take you to there, and we have seen that whether you are in the business of generation, transmission or distribution of power, in the additional depreciation you can do any work. You can do generation business, okay, you can do transmission business, okay, you can do distribution business, okay, you can do only generation, okay, you can do generation and distribution, you can do generation, transmission, distribution, all the three business, yes, also allowed for the additional depreciation. Here any combination is allowed for the generation, transmission or distribution of power, but for the purpose of SLM, there is only generation business and generation and distribution business is allowed. Understood. Tell me that. Only generation and distribution is allowed. Transmission is not there and only distribution is not there. So you can write transmission business not allowed or only distribution not allowed. Only generation is allowed, generation and distribution is allowed. Now, point number B, I need to understand this particular example. I'll also give you the glimpse of section number 50A, what it is, and we'll see in the detail of capital gains. Shall I move forward? Now, what is the example? This particular example says that, let me take this particular example in the notebook. Let me take this particular example in the notebook. Suppose this is the example. Yes. Listen to me. Actual cost of the asset is 1 lakh rupees, whose life is 10 years. After 3 years, the asset is sold for 50,000, 80,000, 120. Okay. Now listen to me very carefully. We are solving the point number A only. What is the WDV of the asset? Can you tell me WDV of the asset? We are solving from the SLM method now. Yes. So the actual cost is what? 1 lakh rupees. Life is 10 years and it is talking about after 3 years. So the WDV is going to be 1 lakh minus 1 lakh divided by 10 multiplied by 3. That is the depreciation for the 3 years. Dep for the 3 years minus 1 lakh. So the WDV is going to be rupees 70,000. Tell me that. WDV is going to be 70,000 rupees. Yes. So my asset is now worth of 70,000 rupees. Now there is a catch. In the three examples, see, there are three examples. First example, that the asset is sold for 50,000 rupees. Second example is sold for 80,000 rupees. Third example, it is sold for 120. Understood? Now we are doing what? Particulars. Simply says that, see, my asset costing was rupees, my asset WDV was 70,000. And its selling price is what? 50,000, 80,000 and 1,20,000. Understood? Now the government is saying that we are just focusing on this part. Okay, ignore this part, as of now. We are just focusing on 50,000 wala part. Understand it very carefully. The government is saying that because of the depreciation, your WDV is 70,000 rupees. But in the actual market, na, your product is of your asset is of 50,000 only. No one is agree to pay you more than 50,000 rupees. That means the asset is devalued more, and we, as per the purpose of income tax, we have not devalued the asset that much. We have only devalued the asset by 30,000 rupees, but in market it is depreciated by 50,000 rupees. We have charged the less depreciation. Do you get the feeling of this? We have charged the less depreciation. So the government says that the balance na, this balance 20,000, we will term it as terminal depreciation. We'll term it as terminal depreciation. What is the meaning of terminal depreciation? That is depreciation which is applied at the termination of the asset, which is applied on the termination of the asset. Why it is terminated? Because it is the selling price. We are selling the asset. Na? See, the asset is sold. So at the time of termination, whatever the depreciation we are allowing, na, it is known as what? Terminal depreciation. The logic is clear to you. The government is saying that in the market the cost of the asset is only 50,000 rupees, but in the WDV it is showing the 70,000 rupees. That means we have charged the less depreciation. We have charged the less depreciation to take more depreciation from it. If we take additional 20,000 rupees of the depreciation, then 70 minus 20, my asset will come on 50,000 rupees, and it is okay. Understood? First point is clear to you. Second point. Second point. Now the same logic. Now the same logic. The WDV is for 70,000 rupees. But now the selling price is 80,000 rupees. Now the government is saying, wait. Now the government is saying that you have charged the more depreciation. We allowed you 30,000 rupees of the depreciation. That is why the value is coming 70,000 rupees. But in actually, the market appreciated it with only 20,000 rupees. The market is ready to purchase the asset at 80,000 rupees. That means we have charged the additional depreciation. So please give it back to us. Give it back, this 10,000 rupees. Give it back. So the government is saying that we are going to charge the tax on this particular 10,000 rupees because we have given the deduction extra in of this 10,000 rupees in the previous year. Okay, we have already given this 10,000 rupees as a deduction, but we have given this extra deduction. Why? Because the market is ready to purchase the asset is 80,000 rupees, but we have only charged the 70,000 rupees. So the government is saying that this 10,000 rupees which we are going to charge, okay, as your profit, this is known as what? Balancing charge. Balancing charge. That means to balance my profit, to balance the tax structure, I am charging this 10,000 rupees to your profit and taking the tax back. Understood? Is this point clear to you? Now coming to the last point. If the asset was of 1 lakh rupees. The asset is of 1 lakh rupees. The asset is depreciated to 30,000 rupees. See, the asset is of 1 lakh rupees. It is depreciated to 30,000 rupees. So the WDV is 70,000 rupees. But the selling price is 120. That means the selling price is over and above the actual cost. I purchased the asset for 1 lakh rupees. After using the 3 years as well, the asset price does not deplete, it actually increases to the actual cost as well. So the government is now doing two things. Now the government is saying two things. See, listen to me very carefully now. Government saying that up to the cost, up to the cost, or what is above cost. Up to the cost is what we have charged. What? See, the same logic applies of 80,000 here as well, because the government has given the more deduction. Actually, the deduction should not be allowed. The asset is ready to purchase for 120, but we have given you the deduction. Actually, the deduction should not be allowed to you because this is the appreciating asset, not the depreciating asset. Okay, so up to the cost, the government said that up to the 1 lakh rupees, we have given you 30,000 rupees of the depreciation. Now, this 30,000 is going to be what? This 30,000 rupees, that is 1 lakh minus 70,000, which we have given as a depreciation. We shouldn't have given this. So it is going to be the balancing charge. It is going to be the balancing charge. Understood? This point is very much clear. It is going to be the balancing charge, like in the point number B. The same logic applies here. Understood. But above cost, the asset was of 1 lakh rupees. I sold it for 120. So the above, that is 20,000 rupees, which I get extra. It is going to be what? Capital gains. It is going to be what? Capital gains under section number 50A. Under section number 50, it is going to be capital gains. Over and above the cost, what we are recovering is going to be the actual, or is going to be the capital gains. So up to the cost, that is 30,000 rupees, that is up to the cost, is going to be the balancing charge, which is with the basic logic of point number B. Understood this particular example? Clear? Now see what it says. Actual cost of the asset if rupees, this is the equation that we have seen. Now solution. WDV is 70,000 rupees. Point number A, this 20,000 rupees, case number A, is going to be the terminal depreciation. Point number B, this 10,000 rupees is going to be the balancing charge, which is going to be taxable. Yes. Point number C, which is 50,000 rupees, we have to bifurcate. 30,000 rupees up to the cost of the asset is going to be the balancing charge, and the balance 20,000 rupees shall be treated as the short term capital gain under section number 50A. Whether this particular example is very much clear to you now? Clear? Very easily with the logics, clear or not? Tell me that. Done? Now, coming to point number, section number 50. Coming to section number 50. We are going to start the section number 50 after a break. We are going to start the section number 50 after a break. Okay, after break, we are going to cover section 50, 33AB. We'll try 33ABA, and whatever we can do, we'll try. Okay, so we'll cover it. Till now, take a break. We have completed approximately good stuff. Revise it, because it is what we have studied in the first half is a technical thing. Okay, you need to remember and recall each and everything. So take your time, take 5 or 10 minutes break. No issues, because it is your part, it is the next part. You can take a break as per according to you. So take 5 to 10 minutes break, revise each and everything, then come to the next part of the lecture, that is part number B, and then we'll start with section number 50. All the very best. Keep writing, keep revising, keep recalling, and keep sharing us your feedbacks, your reviews on the number that we have given to you. All the very best.